I always start off my sessions by revising what we had learned in the previous session. So, all of you who are here, you all attended the last session also. So, just let me know what all did we study the last time. Do you remember? Have you revised your concepts? What all did we learn the last time? Yes, we did the ratios chapter. What were a few category of ratios that we have learned as a part of that chapter? Can you name a few categories? Okay, profitability, efficiency, there were more, gearing ratios, liquidity ratios, investor ratios. Yes, that was the last category that we had studied. Yes, Nidhi, the total shareholder return was part of the investor ratios. You're all correct. Okay, so keep practicing and keep revising from the previous portions also, so that you people do not forget. Ultimately, when we come to the end of the syllabus, it should not be that the chapters that we did in the beginning, those you keep on forgetting, right? So whatever notes that you take in class, ensure that on and off whenever you get time, for example, if you're working or if you're going to college, so during your commute you can go through your notes that you make so that you never forget what you have been learning. So this was a quick revision of what all we did yesterday in the previous session. Also, let me know, have you people practiced the practice portion from the study hub, which was a part of your homework the last time that I told you people to do so? How many of you have done the homework? Okay, that is great to see. And were you people able to solve the questions over there? Any difficulties that you faced? Okay, all right. So in case you face any difficulties, Livin, there were more than 5 questions. I'm talking about the practice portion from the study hub. It's not the quiz, only the quiz has 5 questions. The practice portion has multiple questions. I think the first one, the ratio analysis, I'm not very sure. Let me just check. So if I see over the ACCA study hub, whatever difficulties that you people can face during your practice, you're all welcome to ask me any number of doubts at any time. The group that we have created is for this purpose only, so that we can all discuss these kind of doubts together. And you can always message me personally also. The ratio analysis chapter has 7 questions in the practice portion. So that was something which you people had to do, live in, and not 5 questions that were there. 5 questions we did together as the part of the quiz. But the remaining ones, the ones that you see in the practice portion of the study up, that is what your homework was. Okay, sixth and seventh were difficult. In case there is still anything that you find difficulty or you would want more explanation in, you can drop those questions on the group and I will try to explain it to you people with the help of voice notes. And if still there is any doubt that exists, then I will be answering those questions live with you people. Okay. So in the class, we can take it up sometime. So now for today's agenda, we have chapter 1 in our bucket. We will learn all about the financial management function. So till now, whatever sessions we've had, I've given you an introduction, I've given you the orientation. We have covered chapter number 19, but chapter 19 was not really FM. Today, with this session, we are getting into what really FM is. We will learn the backbone, the core concept of FM, and then we will proceed further into the different areas of the syllabus, which I told you people about in the last session that we met. So we had investment appraisal, we had financing, we had the cost of capital, we had the working capital. So all of these areas, risk management, these are the areas that we will learn deeper about. Firstly, we will start off by getting an introduction to what FM is. Here in this chapter, you can see this flow chart is in front of you. This mind map tells you what all you're going to be learning as a part of this chapter. So, firstly, we will learn about the role of financial management, where we talk about the nature and purpose of it. Then we will learn how is FM related to financial accounting as well as management accounting. I think somebody's microphone is on unmute. Please ensure that all of your microphones are muted so that there is no disruption in the flow of the class. So, what all we are going to learn as a part of this chapter, we will talk about how FM is related with financial and management accounting. Some of you may have already covered these papers in your knowledge level. Those of you who did not take any exemptions, you would know what is financial accounting, you would know management accounting because you've studied the entire papers of based on these titles. Those of you who haven't, no problem. I will explain it to you in easier language also from the scratch. So no need to worry if you had taken exemptions. Then we will learn further about what is it is that a company wants to achieve, what is a strategy, what are the objectives of a company, what do we mean by financial objectives, and if majority of the businesses are operating for profits, there are some other kinds of entities also. Some entities are like NGOs. They operate for serving some benefit to the society, doing something good, providing education, providing healthcare. So those are people who are not looking for earning profits, but they're looking to help the society. So how do organizations like these measure their performance? Because here, measuring their profits is not going to make sense because it was not their objective to make profits. So how do we find out whether these companies are performing nicely or not? We will learn that also in this chapter. And then we will talk a little bit about the environmental issues. Ultimately, we will end this chapter with learning the conflicts of interest. So we will talk about the agency theory. Who are the stakeholders? If you've already done probably the audit paper or in the knowledge level also, we get to know about the agency theory. Then we will talk about what are the different stakeholders for a company, how are directors and shareholders related to each other, um, what are the different schemes that we can use to reward our managers, and we will also talk briefly about the concept of corporate governance. Again, corporate governance is one such concept which, if in the knowledge level, you would have studied in the FA paper. And if you talk about the skills level, audit is the paper where you talk deeply about the corporate governance concept. So this is all that is going to be there in store for us in this particular chapter. Now we will get started with the concepts. So the very first concept that we are going to learn, we are studying a whole paper named as financial management. So we will learn what is the definition of financial management, what it is that we are going to spend the next 2.5 months learning all about. So financial management, before you have a look at this technical definition, I would want you people to give a thought. Financial management, there are two words. One word is financial, another word is management. Can you people let me know, if we break this down, what does the word management mean? What's the meaning of the word management? Yes, guys, what does the word management mean? To look over something. When you run your business, that is when you say you are managing something. It's not necessary that you will only need to manage businesses. Even your households are managed by usually our mothers. So this is how, management is basically getting things done, right? If you talk about the bookish definitions, or not so bookish also, if you talk about how you define management, it's basically getting things done. So you take care of something, you get some things done, you get some work done in an efficient manner, in an organized manner, so that everything is structured. And what does the first word, financial, what does the word financial mean, guys? What does the word financial mean? Something that is related to money. So, absolutely. Here, now you combine both of these meanings together. Management was to look after something, to take care of something, and financial means anything which is related to money. So, financial management, these words combined together, what would they mean? They would mean that when you take care of money in the organization, That is the simplest definition of financial management. So if you have to explain it to a kid, you can just say the person who manages the money for a company, that person will be called as a financial manager, and the work that he does will be called as financial management. Now we will look at the technical definition that has been given to us. So the technical definition tells you it is concerning about efficient acquisition and use of short term and long term financial resources. Now, again, this is looking like a very complex definition. So, what we will do is whenever in life you feel that something is getting complex, just divide it into small parts. Small parts, you understand the meaning of those small portions and then put everything into the big picture together. So, here I will break these things down again. First word, the keyword I will say is acquisition. Another keyword is the usage. Another keyword, if we say, is the short term and long term financial resources. So, if I talk about financial resources is everything that is money and everything that is related to money. So, a business can be having money directly in the form of cash, it could be in the form of bank account, it could be in the form of receivables, it could be in the form of investments that the company has made. So, these are all called as financial resources. Now, the financial management, basically, with this definition, where we are saying that it is short term as well as long term, this is telling you that financial management is not restricted to only one duration of time. It's not restricted to only 1 year, it's not restricted to 2 years, 3 years. It will deal with the short term also, it will deal with the long term also. So, whatever financial resources that the business has, we will be dealing with both short term resources as well as the long term resources. Now, what are we going to do with these short term and long term resources? We are going to do two things. What are those two things? First thing is the acquisition. What do you mean by acquisition? Normal English language word. What does the mean acquisition? What does the word acquisition mean? To acquire something, to get something. So that means in a company, who will be responsible to bring the funds? It will be the financial management function. The person who heads the financial management function is called as the financial manager. So that person will be responsible to acquire, to bring the funds into the company. And then we do not just stop at getting those funds for the company, we also decide how those funds are going to be used. So the usage also is a part of what the financial manager is going to decide in his role of financial management. So first thing is that he will get the money for the company. Then he will also decide how that money is going to be used. So consider if all of us together, if we are thinking to create a company together, so we want to open a business where we want to, let's suppose, manufacture t-shirts. Now, if we want to set up a t-shirt manufacturing company, what will we have to do? We will have to buy the machines in which the t-shirts get made. So for those machines, what do we need? For anything that you want to do in the world, what is the one thing that you always need? Money. So it will be the part of the financial manager who has to bring in the money. So first you bring in the money. Now money has come in. Now what do? Is we go out and purchase those machinery that we need for the setting up of this factory. Now that money is spent, we got in the machines, we started with the production. So now we have decided that we got that money. Firstly, we acquired the money. Where did we get the money from? Maybe we took a loan from the bank. Maybe we all went to our parents and we told them that we're starting this business and we want some capital from you. We will pay it back to you once the business is up and running. So these are a few ways with which we can get money. So now let's suppose we have the money and we have started the business. So first we got the money and then we decided that we will use this money in this particular business. So this is what financial management is concerned about. All of the money related resources, money as well, directly cash and cash equivalents, plus the monetary resources, the financial resources, the management of that is called as financial management. And what is management concerned about? It is concerned about acquiring, it is concerned about bringing the funds and then actually using them also. And while we are acquiring the funds, while we are bringing the funds, and while we are using the funds, we also have to take care of one quality, which is called as being efficient. Do you people understand the meaning of the word efficient or efficiency? What does it mean? What does being efficient mean? in the best possible manner. Exactly. That means you are not doing any wastages. So, what could be the best example? If, let's suppose, when we eat food at home, so whenever we are about to finish, you would often find your parents telling you, finish all the food that has been put in your plate. So, whatever resources that have gone into cooking the food, so that those resources do not go to waste. So, when you talk about efficient acquisition as well as usage, this means that if, let's suppose, we have raised money from the bank, now we took a loan for $1 million, but actually we are only using maybe $700,000. So, do you think it made sense? We are paying interest on the whole 1 million amount, remaining balance is lying unused in our bank account. Do you people think it makes sense to take entire $1 million of loan when we only need $700,000? Do you think it makes sense? No. So, if the usage of the resources, acquiring as well as the usage has to be efficient. That means whatever you have with you, use the thing to the best of the capacity. If you are hiring someone, ensure that they are working for all the hours that you are paying them for. This is the meaning of efficient usage. If you have a factory, use that factory to manufacture the goods. Do not let that factory go to waste. So that is the meaning of efficient. So, in financial management, what are we supposed to do? We are supposed to take care of short term as well as long term money related aspects, which has to be used and brought into the business in the most efficient manner. That means we are not doing any wastage with the resources. So, this is the complex definition of FM broken down into small parts and then we put it all together. Is there any query in the definition of FF? This is the most important thing because the paper itself is, called as financial management. So the definition should be crystal clear to everyone. And if it is crystal clear, you will not even have to memorize the parts of the formula of the definition, right? Okay. So you're all with me till here. Any queries? Are we good to proceed? Okay. Great. So now I talk to you people about the three decisions that we have to take if we are doing financial management. So let's go back to the example that we had taken. So we are manufacturing this, we are setting a business where we want to set up a t-shirt manufacturing company. So what do we do? What had we decided? That the very first thing that we have to do for anything in the world, we have to have money. So the very first thing that we did was we go outside of the company and we try to bring the money. So the very first decision that we had taken was your financing decision. So financing is all about where the money is going to come from, where, how much of money is going to come from which source of finance. That is what is a financing decision. So that's the first thing that we did. We went out, we took a, let's suppose we took a loan from the bank of $1 million. So this is the first decision that we took. This decision will be called as the financing decision. What do we do as a part of financing decision? Here we are concerned all about raising the money. So where is the money going to come from? Sometimes, let's suppose if I need $1 million, maybe I have 0.5 million as my savings. So that I will put into the business as my own capital. And then the remaining balance I will take from the bank as a loan. So this is what my financing decision is looking like. I total needed $1 million. And then I decided how much of it is going to come from which source of finance. 50% of it came from my own savings, 50% of it came from debt. Maybe 50% can also be coming from equity. We issue the shares to some other people outside the company, some investors. So this is what you call as a financing decision. Now let's suppose you got in the money into the business, investors have agreed, bank has agreed to give in a loan. Now you have those $1 million. Then what did we do? We decided that we will be buying the machinery that we have to do for the manufacturing of the t-shirts. So the second decision that we took is called as the investment decision. So once the business has the money, where are you going to invest that money? That is a part of the investment decisions. So here investment decisions talk to you all about where the money is going to be invested, how much money will be invested in which project. This is what investment decisions talk to you about. So how are you going to evaluate which project is good for the company, which project should be taken, which project should be rejected? Because not every project is a good project, right? Sometimes opportunities may come to you, but there is a possibility of making losses. So we have to do an evaluation that if there are multiple options available to me, which option will be the best option for me. So when we decide where to invest our money, that part of the decision making falls under the investment decisions. Now, what all were we doing this for? I had done this investment in these machinery that I used to manufacture the t-shirts. Now everything is in place, machine has been purchased, we've done the investment, and now t-shirts are manufactured and they are sold to so many customers. Fortunately, we received a very good response, and now we have generated good amounts of profits. Now let's suppose 50% of the capital that we needed came from equity. Now, if the company has made profits, firstly, you people let me know who is the real owner of the company? Who is the real owner of any company? It is the shareholders. So, if the company has made the profit, who does this profit belongs to? This profit also belongs to the shareholders. So, how much of profit we are going to share with our shareholders? Now, if let's suppose the business has made $100,000 of profit. So is it mandatory that we have to give this entire $100,000 as dividends, or can company save some money from this? Maybe if 60,000 we are keeping in the company, maybe we have to invest sometime again in the future. 40,000 we have decided that we will give it to the shareholders. So the profit that you share with the shareholders, what is that profit called as? What do you give when you want to share the profits? It is called as a dividend. Exactly. So, dividend decisions are all about how you are going to share the profits with the shareholders. Firstly, you decide, do we give a dividend or do we not give a dividend? Because legally, it is not mandatory for a company to give the dividends to the shareholders. It is the choice of the company. It is the choice. How do companies decide? Shareholders are going to have something called as an annual general board meeting. Do you people know about this term? AGM, annual general meeting of the shareholders. So there all of the shareholders meet, the directors of the company come in and they tell that this year we have made these many amounts of profits. The directors tell you that right now we can afford to give you this much dividend. Would you like to take this much dividend? So if the shareholders, you people have studied already that when you buy equity in a company, you have a decision making power. You get one vote with every share, right? So the shareholders cast their vote that do you want a dividend? They can say yes or no. So as per the majority vote, it is decided how much dividend will be given, if dividend will be given or not given. So dividend decision is all about the company deciding, firstly, will we give a dividend or not give a dividend this year? Secondly, if we are giving a dividend, how much dividend we will be giving? If we are giving a dividend, what way will that dividend be financed? Do we pay cash to our shareholders or do we offer extra shares in the company for free, which we call as a when the company gives extra shares in the company for free, what is that issue called? Do you people know that? Bonus issue. Absolutely correct. So here, dividend decisions will be concerned everything related to the dividend. I've already told you what is the meaning of dividend. It is the part of the profit which company shares with the shareholders. So in dividend decisions, you take all the decisions related to the dividend. Will we give a dividend or not? If we will give, how much dividend we will give? Where will the money come from? Will we give cash? Will we be doing a bonus issue? So this is what we do as part of the three decisions. Mostly everything that you're going to do as a part of FM, they're going to fall under either of these three categories that we have learned. I will again repeat it. Firstly, we started off with the financing decision where we got in the money. How much money is needed? Where will the money come from? From which source? How much will come from equity? How much will come from debt? Then we decided to invest that money somewhere. So, how do you do the decision? That is under the investment decisions. And then once investment is made and it turns out to be profitable, how those profits will be distributed to the shareholders, that is called as the dividend decision. So these are the three decisions which any financial manager has to take when they are doing financial management. Do we have any queries in here? Anything that you need further clarity upon? All good, everyone? Please let me know if you have any doubts. Okay. So now I proceed further to how these decisions are going to be interrelated with each other. So interrelated, you people understand the meaning of the word interrelated? What does interrelated mean? What does the word interrelated mean? Connected with each other, dependent on each other. Exactly, you're all correct. So here, what the concept is telling you is that the decisions, the three decisions that we have just learned, they are all connected to each other. How are they connected? Let me give you an example. So let's suppose we took up a dividend decision. We have decided to increase the dividend that we are paying to the shareholders. Let's suppose we had earned $100,000 of profits this year, and we have decided to give this entire profit as dividend to the shareholders this year. Now, if I have increased the dividend, now I have paid the shareholders, shareholders are very happy. But now, after paying the dividend to the shareholders, the company is not left with any money. So now a very good investment opportunity has come up. But do we have any money? Can we invest any place? Can we buy that investment or not? No, because we do not have money. So if we do not have money, which decision will we have to take? If I do not have money, I will have to take a financing decision. Absolutely correct. So you see this over here. If you increase the dividend, you will also see an increase in the need for finance. Your business will need more money. So you see how you took one decision, which was the dividend decision. This also impacted another decision, which was the financing decision. Another example can be, let's suppose I have increased my investment. I have decided instead of buying 10 machines, I will now buy 20 machines. So again, if I have decided to increase my investment, now for those 20 machines also, more money will also be needed. Machines do not come for free. So I will again see a need in the increase in the need for the money that the business needs. So again, if I have decided to increase the investments, I will also have to raise more finance. So multiple decisions. If you take one decision, other decisions also get impacted as a result of it. So this is why we say that all three decisions that we take in financial management, they are not isolated, they are not separated, they are all interconnected. They affect each other. What you do as a part of one decision will also affect another decision that you have to take. So this is the interrelatedness of these decisions. Now we will learn about how they are connected to financial management, financial accounting, as well as management accounting. So can anyone quickly let me know what do we mean by financial accounting? Many of you would have already studied that paper, or even if you have had the exemptions, you would still know the meaning of financial accounting. What does financial accounting mean? I'm waiting for your answers. Okay, Madhumita says it's the recording and classifying the transactions in the company. Is it just that? You identify, you record, you classify, you summarize, then you interpret, and then you distribute the records to everyone. This is the whole process of financial accounting. So it's a very big process. Basically, if in very simple language I tell you, it is concerned with when we are recording each and every transaction that happens in the company. We prepare the financial statements and then we publish it for the people who want to take their decisions using those financial statements. So it's all about the past records that the company has maintained, everything that has happened in the past of the company, because the accounts are always prepared for the year ended. On the balance sheet, you will always see for the year ended this date. So this is financial accounting. Now, how are financial accounting and financial management related to each other? First of all, they are both very different. Financial accounting stops at the recording of all of the transactions. But with the definition of FM we have studied, FM is much more than financial accounting. We do so many decisions over here. In financial accounting, no decisions are to be taken as such. So, how can financial accounting help a financial manager? Whatever are the accounts of the company that are prepared using financial accounting, those accounts can help a financial manager. How can they help a financial manager? If you are a company that is listed, what do you mean by a listed company, guys? Do you know what's a listed company? Okay, Livin says it's a company that's there in the stock market. So any company that has gone public, they have their shares out issued in the public, not just private shareholders, but those shares can be traded in the market. I can go to the market and buy the share. So few examples would be, if I talk about Indian examples, it would be Reliance Industries, it could be Infosys. Yes, exactly. We have two stock exchanges in India, Bombay Stock Exchange and the National Stock Exchange. So they are all exchanges over which you can go and buy and sell the shares of these companies. That is what is a listed company. So with a listed company, you will get the information about the leases, about the gearing, about the ROCE. ROCE, gearing, these are two terms which we have covered yesterday also. Gearing is all about the debt. ROCE is how much return the company has generated on capital employed. But can you people let me know the meaning of leases? Have you heard this term before? Do you know what a lease is? Okay, Nidhi says it's rent. So it's very similar to a rental agreement. Basically, what do we do? Yes, it's just like renting. So whatever asset that I have, let's suppose I'm not using that asset right now. So if somebody else wants to use it, I can enter into an agreement with them that I am giving that particular asset to them for rent. So they can lease it. It will be for a fixed period. There's a proper contract that we draw for it. So whatever leases the company has entered into, those are also a part of financial accounting because we have proper IFRS standards which tell how leases are to be recorded in the books of accounts. So, with the books of accounts, a financial manager can learn about the leases, can learn about how much debt the company is already having, and how much return the company is able to generate. So, these all things are important. They can help the financial manager in taking the decisions. Then you talk about management accounting. Can you people let me know what do you people understand by management accounting? How many of you have taken the MA paper? Any starters from any people who have started from scratch and not taken the easier route of exemptions? Yes, absolutely correct, Livin, and as well as Alka. So Livin is telling that like FA was concerned about the past, MA is all about the future. It's all about the planning. And Alka says that it's related to the performance of the company. So you're all correct over here. Management accounting, as the name itself is telling you, here we are doing the accounting for the management. What is management responsible for? They are responsible for past, present, as well as the future of the company. So here the management is going to plan that how the company is going to go forward in the future. Will we be launching any new products? Will we be, setting the selling prices at a particular amount or not? So management accountants can need a lot of variety of information. So here there are no fixed formats also. Like in financial accounting, the formats are given to us by the IFRSs and the IAS. But in management accounting, there are no fixed formats. Whatever formats will give the management the suitable way to look at the information, that is the format that they are following. So, management accounting has information that tries to forecast the future because when you are managing a company, you have to take care how the company will do in the future. So, for that, you create forecasts. Do you people know the meaning of a forecast? There's weather forecast also. What does weather forecast tell us? Okay, Nidhi says related to the future. So you try to predict, as absolutely correct, Lekhna. You try to predict the future. A forecast is a kind of a prediction. So the management also tries to do a forecast. They try to create a budget. Budget is when you are planning to think about what will your future look like, how much money will come into the business, how much money will go out of the business. Money comes in the form of sales, money goes out in the form of purchases, in the form of expenses. So, how is the budget of the company going to look like? Management accounting creates these budgets, they create a cash forecast. So, all of these things are also going to help the financial manager. How? If let's suppose a cash budget was prepared by the by the management accountant, and that budget shows us that we will have a negative cash balance. We have a shortage of money in the future, that is 2 months from now. So in 2 months from now, we will go short on money. So now, if the financial manager gets to know this from the help of management accounting, what will this financial manager do? Whenever you people run out of cash, what do? You go to the ATM and you take out more money. So if the business is not going to have positive cash flow, they are going to run out of the money. What will the financial manager do? He will do a financing decision. He will go out to the bank and he will tell them that 2 months later, we are going to need this much amount of loan from you, so that the processing can get started earlier, so that we actually do not run out of money and the business can run smoothly. So you can see how management accounting, financial accounting, they are both going to help the financial manager in taking the decisions, so that financial management of the company can be done nicely. Okay, any queries still here? Are you all with me? Okay, great. So now we proceed further to the second leg of this chapter, where we will learn all about a company. So, why is a company formed? Can you people let me know, why do you form a company? Very easy answer. Why do we form any company or any business? To earn profits? Absolutely. There's only one topic that is common in everyone's syllabus, that is to create wealth, to make money, to earn profit, to run their livelihood. So now, whatever the company wants to do, whatever company wants to achieve, can it just be achieved only by thinking about it? If I just keep thinking that I want to make profit, can I do that without actually doing anything? No. So, whenever I set any goal, whenever I want to achieve something, I also have to do something to achieve it. So, let's suppose you're all planning to attempt the FM paper in December 2025, and you want to pass the paper with good marks. This is your target, or you can say what you want to achieve. Now, can just thinking solve this purpose of yours? No. You have to do something towards it. So, what do you do something towards it? You try to frame a plan. So, you have this strategy in your mind that if I do the syllabus on time, I do the practice of all of the resources that are available, I go for mock exams, I go for the practice of examiner reports, and then I will attempt my final exam nicely. So, this is the strategy that you have prepared for yourself, that to achieve the goal that I want to achieve, these are the things that I will be doing. So this is called as a strategy. So you can see the definition of strategy is the course of action. Course of action means the steps that you are planning to achieve your short term or long term objective. So if I talk about any business, let's suppose the objective of the business is to make profits by doing a manufacturing of t-shirts. So, what is their strategy going to look like? They will strategize by creating a plan. They will create a course of action that we will set up this machine. We will incur these expenses in materials, and then we will charge a profit and then sell it to our final customers. This is the way that we try to achieve our final objective. So strategy is the plan, it's the course of action, it's the steps that you decide to achieve your objective, because objective will not be automatically fulfilled. This is not a magical dream world. Whatever you want to achieve, you will have to do something about it. So the what are the steps that you do to achieve that objective? That is called as the strategy of the business. Is the term strategy clear to everyone? Yes? Okay. Now, when you talk about company, you say that company's another name is corporate. So when you decide the strategy for a company, then you call it the corporate strategy. You are planning to study for the FM exam, you prepare a strategy to clear the exam, that is your strategy. But if a company has created a strategy, we will simply call it as a corporate strategy. So it is the direction that the company is working towards, because everyone in the company works towards the same objective, that is to maximize the profits. Now, when it comes to the objective of the company, we are saying that all companies operate to maximize the profits. To frame it better, we are not just looking at profits, because profits can be short term also. But whenever you start any business, you want to do it for the long term. You want that your company should go on hundreds and hundreds of years. Then only that company is called as a good company, right? So we have so many examples over here in India also. The traditional businesses which were set up probably at the time of independence, they are still continuing and they are still doing so well. Tata Motors is an example, Reliance Industries are an example, the HCL computers are an example. They were founded very early. It's been hundreds and hundreds of years and they are keeping on going. So this is what the companies are achieving. They want to be successful in the long term. So when they talk about what do we want to achieve as a part of financial management, the primary objective why we are doing so much of this hard work, why we are going to spend the remaining 2.5 months to study and learn about this. Why are we doing that? Because we have the sole objective of maximizing the wealth of the shareholders. We have already discussed that the shareholders are the real owners of the company. So if they are trusting us with their money, we are, if you are a director in a company, you are an employee of the company who is working for the owner of the company. Who is the owner? It is the shareholder. So as a director of the company, it becomes your responsibility to earn the maximum possible profits for the shareholders. So whenever the company is doing anything, whenever the management takes any decision, they only have one objective in their mind, which is to maximize the wealth of the shareholders. What do you mean by wealth? What is the difference between profit and wealth? Do you people know the difference? Is profit and wealth the same? What's the difference? What's the difference? Who will give me an example to explain this? Wealth is the increase in the value of the assets, but so is profit. No, you're all missing the crux of it. See, I can make millions and millions and billions of dollars of profit today. But what can happen is that money can be spent tomorrow. That money can turn into a loss tomorrow. Will you prefer being a person who just earns $100 million today and then uses that money to spend that over the rest of the life and not earn anything else? But there's another person who is earning a consistent sum of money, some person who is earning 1 million every day, and that money is again invested somewhere to make more money on it. What would you prefer, the first or the second case? The second case, of course. So when you build money, when you build returns over the long term, that is what is called as wealth. Profit is always a short term concept, and wealth is always a long term concept. Lekhna is saying profit is money earned by the wealth invested. Not really. The idea is behind the sort of timeline are you focusing upon? Profits and losses, they're always short term. Wealth is always long term. So if you talk about probably the singers who come and go, usually the singers have prime time. So that's the time when they are at the peak of their career. Everyone knows them then, but then the popularity fades away. So the person who is only famous for a small amount of time, you will say that they make a lot of profit. But if you talk about somebody who is consistently famous right from the beginning of their life till the end of their life, so you could talk about some actors who people never stop loving. So those could be the people who will be wealthy because they will make money over the long term duration of their life. So this is the main difference. The difference is only in the timeline. The profits and losses are short term, wealth is always long term. So when we are talking about the financial objective of the company, why are we doing so much of hard work? Why are we learning financial management? We only want to achieve one thing, that is to maximize the wealth of the shareholder, to ensure that the shareholders have good money in the longer term, not just thinking about the short term, but also thinking about the long term. We are thinking that the shareholders should sustain the profits that they make. All right, so this is the main objective that the companies work towards when it comes to financial management. Now, whenever you are working towards only one thing blindly, there are obviously going to be advantages of doing that. At the same time, there will be some things that you will miss out on also. First, let's talk about that if the management of the company is only focused on maximizing the wealth of the shareholders, what will be the benefits? So the very first benefit will be that it will be easier for me to raise money. Raise money, that means when I go to somebody else in the future, they will see that I am giving very good returns to the shareholders. So if I come to you people and I tell you my company doubles the money after every 2 years, would you want to invest in my company? I come to you with a very lucrative scheme. I say that I will give you so good returns that your money will double after every 2 years. So everyone will want more money, more return on their investments. So it will be easier for me to raise money. So investors are going to trust those companies who deliver good returns for the shareholders. Example has also been given for you that a company like Apple has been in the business for a very long time and they deliver returns to their shareholders. So Apple can very easily raise funds. Another benefit, if I focus only on wealth maximization, is my customers should also be kept happy. Why should the customers be kept happy? If let's suppose I am focusing too much on my profits, what will happen? Let's suppose I am charging high selling prices to maximize my profits. Then the customers are going to be happy about paying high prices or not? Think from the perspective of a customer. Do you want to pay high prices? No. So your customers should also be kept happy if you want to maximize the wealth of the shareholders. Because today, if I sell for very high values, today I will make very good profit. But then tomorrow, the customer is probably going to go to my competitor because he will think that the competitors are offering it for cheaper. So let me buy the same thing from them. So the company can lose out on business. So the customers should also be kept happy so that we are able to sell the products to them. Another pro that if we are focusing too much on the maximization of shareholder wealth is we will be having good returns so that we can also avoid hostile takeovers. Do people know the meaning of takeover? What does takeover mean? Yes. Lekhna says acquisition. So this is basically when you buy another company. That is a takeover. And do you people know the meaning of hostile? What's hostile? To have full rights. Are you sure? Hostile is the word that you people associate to kidnapping, where you do not have consent to what is happening to you. So a company will try to acquire you without you wanting to be acquired by that company. Right? So this is what is a hostile takeover. I can give you people an example. Do you know who is the owner of the company called Twitter, which was previously called as Twitter? Now the name has also been changed. Who is the owner of Twitter? It's Elon Musk. And what did he do to the company? It was originally called Twitter, but now it is called as? Now it is called as X. So this is the classic example of a hostile takeover. This company called Twitter, they did not have the intention of selling the majority of the owning to Elon Musk. But what did he do? He, you know, deliberately acquired the whole company. He bought the shares of the whole company, and then he eventually changed the name of the company also. So if we are delivering good returns to the shareholders, we can also avoid the hostile takeovers. So if our returns are low, then some people can try to acquire the company. What was the reason that Elon Musk gave to acquire the company? He said that the company is not doing very well. I can take it to very good heights. So if the returns are not so much, the others may try to acquire the company. But if we keep delivering good returns, my existing shareholders will not be willing to sell the company, because will you sell any asset which is giving you good returns? No, right? Because you want to keep enjoying the benefit of those good returns. So this is also another benefit. If you give good returns to the shareholders, you can also avoid hostile takeovers of the company. Another benefit, why should you do maximization of shareholder wealth? It is the legal duty of the directors to take care of the shareholders. Shareholders are the real owners of the company, but because they do not have the expertise, they may not have the time, they cannot all come together at the same place to run the business. So they hire somebody else called as the directors. Directors are appointed by the shareholders on their behalf to manage the company for them. The directors have expertise, they have experience in managing and running a company. So shareholders tell them that this is our company, but we want you to manage this company for us. So the directors are essentially the employees who the shareholders have hired to run the company for them, to make profits for them. So it is the legal duty of also of the directors to bring the profits and wealth for the shareholders. So these will be the benefits when we are doing the maximization of shareholder wealth. But when you focus too much on only one thing, there are other things which get neglected. What are the cons if we focus too much just on making profits, just on maximizing the wealth of the shareholders? Number one thing is that we are ignoring the interest of the public. Public is the general people who are there in the external world. So if, let's suppose, we are running a company where we are doing mining. So what happens in mining is we have to dig very deeper into the ground, and this disrupts the environment. It's bad for the environment. But just because I make profits out of it, I keep doing this damage to the environment. So the general public is definitely going to be badly affected by it. Example also has been given about pollution. So if a company, they are making very good amount of profit, but the company, the factories that they manufacture in, they release a lot of pollution in the area where they operate. So what will happen to the health of the people who live around that factory? Will they be very healthy? No, they are going to get affected. Their lungs are going to get affected because of the pollution. So this is one thing which is going to get ignored. The people around you, they can feel bad if you focus too much on the maximization of shareholder wealth. Another drawback is you will also be ignoring the social needs. So, for example, if you're opening a private hospital, you open a hospital with the objective of making profits. Now, some very, let's suppose a person not from a very good financial background, they are in a very bad condition and they want to get their treatment done. But because you're working for a profit, you charge very high prices. So do you think a normal person will be able to get their, healthcare done from that hospital? Will that be possible? No. So again, you are ignoring the social needs, the basic needs of the people. Examples could be healthcare, which we just talked about. Another example could be education. So you see how, because of this problem only, we have the government setting up the schools, because the private schools have very high expensive fees. Not everyone can afford that fees. So that is why the government has to step in, and the government has to provide for healthcare as well as education. The government sometimes even provides for water towards some of the people who are below the poverty line. Electricity is given to them. So the basic necessities are provided. So if a company is focusing too much on the maximization of shareholder wealth, they are ignoring the basic needs, the basic social needs of people. Another problem over here is that you are ignoring the other stakeholders. Do people know who are stakeholders? What's the meaning of stakeholder? This is again something that you learn as part of knowledge level. Who are stakeholders? You people know who are stakeholders? Yes or no? Nobody knows who a stakeholder is. Okay, Aman says related with a company. You're somewhere there. So basically, stakeholder is any person, any party, any organization, anyone basically who gets affected by the activities of the organization. Absolutely correct, Lekhna. It's the people, it's anyone, not necessarily a people. It can be the organization also, it can be a party also, who can be affected by the decisions of the company, by the actions that the company takes. They can be affected by that. So there are multiple stakeholders, shareholders, customers, employees, general public, tax authorities, government. They are all stakeholders in a company, because whatever the company will do, banks also, they are going to be affected by the actions of the company. So when I am only focusing on maximization of shareholder wealth, I am also ignoring the other stakeholders. For example, the employees, for example, the customers. So if I'm focusing too much on maximizing the profit for my shareholders, I will pay lesser salaries to my employees so that more money can go as profit to the shareholders. I will charge higher selling prices from my customers so that more profits can be generated, which will be given to the shareholders. So just to focus, just to keep my shareholders happy, I'm ignoring the other people. I'm ignoring my customers. I'm ignoring my employees. So this is also another drawback. And lastly, you see, sometimes in some of the private firms, maybe the owners do not even want to maximize the returns. They just want to have a stable business. For example, we could be having a family business, which rather than making profits, it's much of a sentimental value for me. I do not mind making lesser profits, but I want to keep my business running for the long term in the future. So I want stability in my business. So if I'm focusing too much on shareholder wealth, too much on increasing my profits, maybe the stability of my business can be affected. So these are a few cons that if I focus too much on maximizing my shareholder wealth, then these problems or these difficulties can also arise. Read through these points. I'm giving you 1 minute. Quickly read through. Let me know if you have any difficulties or anything that you need more clarity on. Any doubts? Are you all good? Okay. All right. So let's proceed further. Now, how do you measure whether a company is able to achieve the financial objective of maximizing the wealth of the shareholders? Two ratios, which we have already learned yesterday. That is why I start with the ratio analysis chapter. We've already learned the total shareholder return, TSR formula yesterday. It is the closing share price minus the share price at the beginning plus the dividend divided by the share price at the beginning. An example has also been given to us that an investor purchased 100 shares in ABC company at the beginning of 20x0 at the market price of $10 per share. So this was the opening share price. During the year, the investor received a dividend of $1.2 per share. At the end of the year, the shares had an ex dividend market value of 12.9. Ex dividend means that the value of dividend is ignored from it. Excluding the dividend, this is the value of the share. So the shareholders has had two kind of returns. What is the first return? First return is the dividend that they have gotten. Another return is the increase in the share price, which you also call as the capital gain. So 12.9 is the closing value. You got the share for 10, but now it is worth 12.9. So you first had a 2.9 gain of capital gain, and then you received the dividend also 1.2. So your formula, if you use this formula to calculate TSR, it will be closing share price was 12.9 minus the opening share price, which was 10, plus the dividend, which is 1.2, divided by the opening value, which was 10. So this numerical will give you the total shareholder return to be 41%. That means 29% was the capital gain made by the shareholders, and the remaining 12% was the dividend yield that the shareholders have received. I hope this is all clear. We've just covered this in the last class. Total shareholder return, you're all with me? Yes or no? Okay. Now, another way where you can measure if the company has been able to achieve the financial objective or not, that is the EPS ratio. We've also covered this one yesterday. The formula is PAT minus preference dividend divided by the number of shares. So numerator is basically the profit that is left for the ordinary, or you can say the equity shareholders. So an example has also been given with which we can practice EPS. During the year ended 31st March 20x5, George Company reported EPS of 10.3 cents. The company had 400,000 number of shares in issue at 31st March 20x5. On 1st October 2000x5, George Company issued 60,000 shares at the market price. Profit for the year was $57,000. There were no preference dividends that we had given. So here, if we have to find out the EPS, we have just learned the formula. Formula for EPS is PAT minus preference dividend divided by the number of shares. So how can we find out the EPS over here? Firstly, you find out your numerator. Numerator is the profit that the company has made. Uh, they have already given you the EPS of the previous year, which was 10.3. And now the profit for the year has been given to you as $57,000. So if here I want to find out the EPS for this year, I have to take the PAT minus preference dividend. There is no preference dividend. So I will take the PAT as it is, which is 57,000. Now for the denominator, I have to take the number of shares. But here the number of shares did not remain the same for the entire year. In the middle of the year, I had issued more shares. So if you see, the year end of this company is 31st March 20x5. That means April, May, June, July, August, September. 6 months we only had these many number of shares. And then if you talk about the remaining 6 months, I had 460,000 number of shares. So 400,000 shares were there for half of the year. 460,000 shares were there for the other half of the year. So on an average in the entire year, I had 430,000 number of shares in issue. So I will divide 50,000 by 430,000 to get my EPS answer, and this will come to 13.3 cents. So I will say that earlier my company gave an EPS of 10.3. Now the EPS has increased to 13.3. Is the increase in EPS a good thing or a bad thing for the company? It's a good thing. Why? Because the shareholders have earned more money on their investment. Absolutely. So are you people clear with the numerical working? Any doubts? We took out the average. The average is clear to everyone? Okay. All right. So this is how we measure if the company was able to achieve the financial objective or not. Two ratios, TSR and the EPS ratio. Now, always and always, are there only organizations that exist for making profits, or do we have some people who genuinely want to do some good work for the society also? Do we have such people? Do we have such organizations? Yes. And what are those organizations called? NGOs, charities, not for profit organizations. Some people also call them NPOs. Exactly, not profit organizations. So now we will learn how do we measure the performance of these companies. Now, if I want to measure the performance of a normal profit making company, I can simply see how much profits they make. But can you measure, let's suppose you want to see how good a fish is. So if you ask the fish to run a marathon, can a fish run a marathon? No. Will it be fair to measure the performance of a fish with a rabbit? No, because they do not have the same objectives. They're not the same kind of people. So here also, profit-making companies and not-for-profit organizations, they have different objectives. So the way we measure their performance, that should also be different. For a normal profit-making company, we are using the financial measures. We are seeing how much profits they are making. But if my aim is not to make a profit, how will I measure my performance? So for that, we have a model called as the value for money model. It's in short called as VFM, and the full form is value for money. Is there anyone who has studied this model before? Value for money model? Okay, none of you have studied this before. All right, okay. Um, Alka says in double A. Okay, great. Yes, you do have this as a part of the double A syllabus. So, okay, in PM also we do have the value for money model. Absolutely correct. So, the value for money model says that because the objective is not to make profit, let us find out some other ways. How can we measure whether a charity has done good performance or not? So, we have this value for money model. According to this, there are three E's, three E's with which we can measure the performance of the organizations. What are these three E's? They are there in front of you. First is economy, second is efficiency, third is effectiveness. So here we are talking about these three E's. The company should do well in all these three areas. Firstly, when you talk about economy, economy is everything related to the input. So, for example, if you talk about a charity whose objective is to educate the underprivileged children of the society. So, what all inputs are they going to need? If I want to provide education to the underprivileged children, what all do I need? What all will my money be spent on? Faculties, the teachers who will teach the students, the study materials, the stationery which I will give to the students, the books, absolutely correct. Infrastructure, classrooms, absolutely the admin staff. So this is all the input that I will need to achieve my final objective of educating these children. So economy says that you should always try to minimize the cost of your inputs. Get things for as cheap as possible. Try to look for multiple alternatives. If you want to buy stationery, get the quotations from multiple stationery shops. Whoever gives you the cheapest, go with that option because your objective is to give the benefit to most number of people. So try to minimize the cost of your inputs. This is the first E. This is related to economy. Then the second E that you have is efficiency. So efficiency is all about that using the resources. Now we have gotten all of the raw material. I have my faculty, I have my books, I have the stationery, I have created the infrastructure. Now with whatever resources I have spent, whatever input I have generated, I have created, I have put in the input, using that input, try to benefit the most number of people as possible. So if you've spent an XYZ amount on all of these things, try to give the benefit to most number of students, majority number of students, as much as it is possible. You maximize the ratio of output to input. Output should be as much as possible. Input should be as low as possible. So this is what is efficiency all about. And then the third thing is effectiveness. What is effectiveness all about? You use the resources in a manner. Effectiveness, you can say the crux is you will measure whether your final objective is being met or not. So if I talk about an NGO where my objective is to educate the number of people, so how many students were able to get the colleges after studying from my school? How many students grew up to become responsible citizens in the country? So this is how I can measure if my final objective was met or not. So these are the three E's that we have as a part of the value for money model. Now we will have a look at a real life example so that I can tell you how these threes are put into place in the real world. So far I've just given you an idea. Economy is all about inputs. Efficiency is all about the ratio of output to input. And then effectiveness, the core idea is the final objective. Just remember this. Now let's have a look at a real life example where we are talking about a government funded university. So government funded university, these are basically the universities which are set up by the government. Funds are given to them by the government to educate the children, to educate the students in the country, in the state, wherever the university is located. So here, this is a university management. The people who will be managing this particular university, they will have multiple stakeholders. We just discussed that stakeholders are the people who get affected by the activities of the organization. So university management, the stakeholders for them will be the students who study at the university, the government who gives the funds to the university, and the employers. Employers will be who? These will be the companies who come to hire the students for the job. So these are all different people who get affected by the action of the university. So university management is accountable to multiple stakeholders. They are accountable to the students also. They have to listen to the government also. They have to listen to the employers also who can give the placement opportunity to the students. Now, if you talk about the requirement, what will the students expect from the university? What the government will expect? What the employers will expect? Do you people think this is going to be the same thing? Is everyone going to expect the same things from the university? No. How could they be different? Tell me what would be a few things which the students will want from the university. What will the students be looking for? Best quality education. What else? Good infrastructure, uh, play areas, and learning through the latest technology, the information technology. These are a few things that students may demand. What would the government demand from the management? The government gives the funding to the university. So think on those lines also. What would the government demand? Try to keep the cost as low as possible. Try to manage in small amount of funds only. This is what the government will want. But the students want the best quality teachers, the best quality equipment. So all of those things are going to be expensive, but the government says reduce the spending. So what will happen is different people are going to want different things from the university management. So sometimes these requirements can also conflict. How can they conflict? Just now we have discussed the example. The students may want to sit in small class sizes so that the teacher can give the attention to all students. They might ask for a large library. Large library will also mean large amount of money to construct that library, and a lots of options of courses so that whatever students are interested in, they can opt for that particular course. But the government may try to want to minimize the cost per student. If you talk about the employers may want the graduates with relevant skills for the industry. For example, the college may look more for the engineering students rather than the anthropology graduates. So definitely they are going to want those people who can actually do the real work for the company, the people who have learned how to do the work. They are ready for the corporate world. They should know all of the Excel, the spreadsheet, whatever courses that you people are also trying to work upon so that you get the job options easily. So sometimes these requirements, what the stakeholders are looking for, they will conflict. Now, if somebody wants one thing, another person wants to do the opposite thing of that, do you people think it's going to be very easy for the university management to keep everyone satisfied? Will it be very easy to give them everything that they want? No, because everyone is wanting opposite things of each other. So here we have to design a system wherein we can deal with so many objectives. So, what does the management do? They try to rank the stakeholders and they try to prioritize the objectives. So, which stakeholder is the most important? You try to identify the most important people and then you satisfy those people first, and then you try to satisfy the lesser important people. So, this is how in the real world you will see usually that for not for profit organizations, measuring performance becomes even more difficult because everyone wants different things. Multiple stakeholders are going to have different objectives. Sometimes these objectives can also conflict each other, they can contradict each other. Then, if we want to apply the value for money model in this particular university, how can we do use the three E's model? Firstly, if you talk about the economy, so in economy, I told you what is the key word for identifying economy. Keyword for economy was inputs, right? Remember inputs, absolutely. So here in a university, the input will be the cost per student. So I will focus on minimizing the cost per student. Then guys, what was the keyword in efficiency? No, it was not output. Give me the complete answer. Yes, output to input ratio. So the keyword over here was minimizing the cost of input. Keyword over here was maximize the output to input ratio. So we want to maximize this. So here in a university, what will be the output? The number of students who study at the university. What will be the input? The staff teachers who are teaching the students. So this ratio we want to increase. Lesser faculty should teach more and more number of students. So the idea is proper utilization of resources. There should be no wastage. Every teacher should be teaching for the whole day for as many students as possible. And then the last, the third E, what was the keyword for effectiveness? Keyword for effectiveness? I wrote it separately. Recollect. Final objective. Absolutely. So effectiveness, the keyword is final objective. For a university, what is the objective? To provide quality education to the students. So you see how many students were given first class honors, how many students were given second class honors, how many students failed the degree. So this is how you can measure whether the final objective was being met or not. So in a university, practically, this is how the three E's can be put to use. Any queries in the three E's, any queries in the conflicting objectives, let me know. Then we will proceed to an activity where you people will tell me which E pertains to the statement, which E is the talked about portion over there in that particular statement. Any doubts, please let me know. I would appreciate some confirmations from everyone. Yes, you're all with me? Okay. So now we proceed further to an activity where you people will let me know to which of the E's does the above statement pertain. So here are the statements in front of you. First is all about service delivery per dollar spent. So this information, the activity pertains to categorize the following measures of value for money for an international charity. So you have to tell whether it's economy, efficiency, or effectiveness. These all pertain to a charity. Read the first part. Let me know which E is it. Is it economy? Is it efficiency? Or is it effectiveness? Guys, think again. Okay, I was just confusing you all. Yes, you're all correct. This is efficiency. Why is it efficiency? Can you people let me know the reason? I always want your final answers with reasons. What is service delivery? Service delivery is the output. Dollar spent is the input. So this is the output to input ratio. That is why it is efficiency. Absolutely correct, guys. Move to the part B, beneficiary satisfaction. Which E is it? This is our final objective. When we are a charity, we want that the people who get the benefit from our charity, they should be satisfied. So this is our final objective. This is effectiveness. Absolutely correct. Move to the third part. Third part is cost per project activity. Absolutely correct, you guys. The answer for this one is economy. Why? Because we're only talking about input. Input, we're only talking about cost. Nowhere have we mentioned the output. If there was output, then we will be taking the output to input ratio, then it would become efficiency. But here only cost has been talked about. So that is why it is economy. Then move to part D, change in the beneficiary lives. This is also your final objective. So this is going to be effectiveness. Then cost per beneficiary. Correct, everyone? Cost per beneficiary, we're only talking about cost. So this is economy. Then utilization of the volunteer hours. How many hours of the volunteers have you been utilized? Have the hours gone to waste or not? Obviously, yes. The answer is going to be efficiency. I saw one effectiveness. Effectiveness will not be the answer. This will be efficiency. Efficiency is all about maximizing the usage of your resources. Have lesser inputs and more outputs. So if we have volunteers, how many volunteers did we utilize? Did they sit idle or did we utilize them? Did they actually do the work? So this is efficiency. Okay, is this clear to everyone? All right. Then you have resource consumption in programs. What will be the answer for this one? How many resources you have consumed? No, think properly. You have the resources. How are you using them? Sharvari, Livin, Madhumita, you're all correct. It is going to be efficiency again. Why? Efficiency talks to you all about the proper utilization of the resources. When I'm talking about the resource consumption, I'm saying whatever are the resources that I have with me that I'm paying for, am I using them in the program also or not? Or am I just paying it and they are going to waste? So wastage should be minimized. That is what you learn as a part of efficiency. That is why for part G, your answer is going to be efficiency. Are you all with me? The ones who were giving other answers, are you all with me now? Yes? Okay. Last part, procurement savings. Which E is it? Savings. Procurement means the goods that we need for our raw material. How much money are we saving in our raw material? Immediately, this raw material is your input. So procurement, whatever money you're saving there, that becomes a part of your economy. Absolutely correct, guys. So these are all of the answers that we have given. So this was this activity where we have tested further whether we have understood the concept of 3 E's or not. So now we will proceed further to the different stakeholders that a company has. So this was the value for money model. We have discussed this activity. We've practiced the 3 E's. Now we move to the last leg of this chapter where we are talking about the conflict of interest in the different stakeholders. So I told you people already, stakeholders are those people, those parties, those organizations who get affected by what the organization does. So if you are a company, who are the different people that get affected by you? Number one is your equity shareholders. These are the real owners of the company. What do they want from the company? They want that their wealth should be maximized. Another stakeholders is the director. They are the employees of the company. They, what do they want from the company? They want the salaries from the company to be coming on time. They want power and they want esteem. Whenever you talk to any director in a company, the job of being a director, it's a very senior leadership position in any company. So these people have a very strong esteem about themselves. You will see that the CEOs of the company, the COOs, the marketing heads, and all of these people, they're going to show up in very big cars. They'll have Audi, BMW, Mercedes. They will show up in these big cars to meetings. So they have that sort of an esteem in themselves. So they want that the company keeps on maintaining that esteem, keeps on maintaining that power for the directors. Why is power important? Because they are supposed to run the company. Can I run the company if I have no power? If no employee will listen to me, can I run the company nicely? No. So these are the three things which the directors are looking for from the company. Then another stakeholder, the third stakeholder that you have are the employees. What do the employees want from the company? They want a good pay and they want good working conditions. That means the healthy environment should be there. Good work job balance should be there, and there should be a proper, policy in place. There should be no discrimination done on any basis, gender, caste, religion, etc. So these are the basic conditions. Along with that, the employees also look for job security. What is job security, guys? What do we mean by job security? Yes, when I have a guarantee that the company will not lay me off whenever they want to, I have the job for a long period of time. I will not be laid off in the short term. That is what the employees want from the company. What does the loan creditors want? Loan creditors are the people who supply the company loans. So they want security. They want that the company should give some assets as a collateral in case the company defaults. They will sell off those assets. So this could be, for an example, a bank. If the bank is giving loan to the business, the bank will want some security for that loan, something to keep as a collateral for that loan. That in case the company does not pay the money back to the bank will sell off that asset and get their money back. Another thing which the creditors want is a cash flow. Why? Because it is not profits which will pay the interest. What will be useful to pay the interest? We discussed in the last class, profits and cash are different. We have to have cash if we want to pay interest. Another thing is that my creditors will also want long-term prospects of mine. So if they have a bank has given to me a 10-year loan, the bank will also want that my company does well for 10 or more years. Only then I will be able to repay their money back to them. Another stakeholder that you have are the trade creditors. So these are the suppliers who give you raw material on credit and you pay them after 30 days, after 40 days. So what will they want from the company? They will want that the company has good cash flows in the short term, because only if I have the cash, then only I will be able to pay my suppliers on time. And lastly, the larger stakeholder is the community in general, the people who are living in the in the environment near me. So if I have a factory, that factory pollutes the air. We are whatever waste that is being generated, we throw that into the local water body. So the water is getting affected in that area. The air is becoming more polluted. So my actions are affecting the community also. I can also try to do some support for the community. I can have some initiatives where I get the water cleaned up, where I, instead of, whatever pollution that I'm doing, to compensate for that, maybe I can plant some trees in the locality. So this is how, these are a few things which the general community is going to want from the company. So these are a few different stakeholders in the company, and you can see how all of the stakeholders have different things that they want to have from the company. So do people think it will be very easy for the company to keep all of these different stakeholders satisfied? No. So what will happen is, when you try to satisfy everyone, what will happen is you will try to do the bare minimum. Whatever is the bare minimum that you can manage in You will try to do just that. So that is called as satisficing. You can, just go to Google and quickly type satisficing meaning. So it is going to show you when you just do the bare minimum of what is needed, just to tick that box that, okay, I have done this thing. So the company may not act in the best interests of everyone. They will just try to keep everyone satisfied just for the sake of it. When you're not trying to do nice, but you're just trying to meet that checkbox that, okay, I have done this task. There are two things that you can do. If I have given some work to you, either you can just finish the work and submit to me on time. Otherwise, what you can also do is do the work, also do it more sincerely, do it in a better quality. So rather than focusing on quality, if the company has so many different stakeholders, conflicting things that they want from the company, so sometimes the company will just try to satisfy with the bare minimum to each and every stakeholder, because giving what each and every stakeholder wants to the best possible capacity may sometimes not be possible. So this is called as satisficing, because there are so many different things which people want. So the company may only do satisficing. In Hindi, we have this word called khana purti. You will just try to do the bare minimum just to keep everyone satisfied so that there are no fights happening. So this is one thing which can go wrong because of having so many stakeholders who want so many different things from the company. Are you all with me till here? Any queries? Okay. All right. Now let's proceed further to the agency theory. How many of you know the agency theory? Would anyone like to give me a brief idea? What is the agency theory all about? What does it tell you? Absolutely correct, Livin. Directors act as the agents for the shareholders. So we have been discussing right since the beginning of the class that it is the shareholders who are the real owners of a company. So the real owner is called as the principal. You would have heard this term agent also in the form of insurance companies. So mostly insurance companies hire the sales agents who will tell you people, the general public, they will tell the policies of the company, and then they will sell you the insurance policies. So they act on behalf of the company. So here the shareholders are the principals, they are the real owners of the company. And on the behalf of the shareholders, they hire someone called as an agent, who are the directors to act on behalf of the shareholders. The shareholders of a company may be living in different geographical regions. They may not have the expertise to run a company. They may not have the time to run a company. So that is why they all come together and hire people on their behalf to do this work for them. These people are called as the directors. These people are the agents of the shareholders. They do the work. They manage the company on the behalf of the shareholders. So this is the agency theory. We call it as the principal agent relationship. They are both related to each other. Shareholders are the principals. They are the people who the agents work for. And agents are the people who are responsible for the day-to-day operations of the company. So this is the agency theory. Now, if let's suppose you are the owner, the way you will work as the owner of a company versus the way you work as an employee of the company, do you think that will be the same? If you do your own business or if you work for somebody else, that is never the same, right? When you work for your own self, you have another passion, you have a zeal, you have the motivation to do more. But when you're working for someone, you just try to do the bare minimum work, right? That let me just get the job done so that I get my salary on time. So another very good example that you could learn over here, especially this works over here in Indian banks, is that in the government-run banks, the government pays for these stationery that is used to fill in the forms that we have. Sometimes we have physical forms that we have to fill in. So there are pens that are lying over there so that the customers can use those pens. Now, what happens is the consumers pick up those pens and take them away with themselves once they're done with filling the form. The government employees, because the printing and the stationery, everything is kept by the government over there. They even take out their personal printouts from the office printers. So this is something which the employees can do because they are not the owners of the company. They can try to steal something from the company. So a lot of issues can arise because if you are not directly the owner and you are doing something on behalf of someone, there's always a trust issue that can happen. I, as a shareholder, I can think, what if the directors are not acting in my best interest? What if they are working for their own self? What if they are stealing from me? So this leads to a problem called as the agency problem because they are not directly the owners who are working for the company. Issues can be there. So those issues, how do you solve those issues? We have something called as corporate governance for that. What is corporate governance? Now, when the directors are hired for a company, they are responsible for taking each and every decision in the company. So the directors, whatever they decide how the company is going to work, how the company is going to be controlled. So corporate governance is the system by which the directors run the company, by which they control the company, by which they direct the company. So there are some things that we can do as a part of corporate governance which can help us solve this agency problem. What are the solutions or what are the things that we should do if we want to have a good corporate governance in the company? We should have a separate CEO and chairman. Can anyone explain this point? Anyone who has done audit paper, would you like to explain what this point means? What do we mean by having separate CEO and chairman? Who is a chairman? Who is a CEO? Who is the chairman? Who is the CEO? Okay, CEO will be the person who is responsible for the day-to-day operations. Yes, Alka says there will be too much power in one hand. Firstly, you people let me know, do you people know who is dependent, or you can say who is an executive director and who is an independent director? Do you people know that? So there are two kinds of directors that are possible in a company. One is an executive person, executive director. Another is non-executive director. Executive is that person who is going to get the salaries and bonuses depending upon the performance of the company. So if the company does high sales, if the company makes high profits, then these executives get higher payments. But if you talk about the non executive, it's exactly the opposite of them. Their salary is fixed. They get a fixed salary no matter the company is making profits, no matter the company is making losses. So, the shareholders, why are shareholders bringing in non executive people? Because these non executive people are kept to keep a track on the executive people. Now, executive people are getting the bonuses, the money payments depending upon how the company performs. So, what can happen is just to get their share of bonus, just to get higher salaries, what can they do? They can think about the short term thing only about the company. They will probably compromise the future of the company. They may try to do something illegal so that they can make good profits in the short term. But do you people think shareholders are going to like if the directors do something illegal in the company? Will the shareholders like it? No. So they keep another kind of directors in the company called as the non-executive directors. So like how if you when you sleep at night, you have a security guard who takes care of your house so that nobody steals from your house, nobody tries to harm you. So likewise, the shareholders appoint the non-executive directors. These are the people who are paid a fixed salary to ensure that the executive directors work in the best interest of the company, in the best interest of the shareholders, as per their moral and legal duty, to ensure that they are not doing anything illegal, to ensure that they are not doing any wrong decisions which can be bad for the long term prospects of the company. So, when I talk about a CEO, the full form is Chief Executive Officer. So, CEO is an executive director. His salary, his bonus depends on how the company performs. So the CEO can go crazy to maximize the profits, to maximize the sales, just so that his bonus can be a good amount. So, who is needed to keep a check on the CEO? We need someone who is independent, who is a non executive person. So, we hire a chairman. The powers at the top of the organization are divided into two parts. One is the CEO, one is the chairman. Chairman is a non executive director who does not, it does not matter to him how much money the company makes. He is responsible for keeping a check on the CEO. So we divide the power so that the CEO does not have all the power in his own hand, so that he does not take any bad decisions which are not good for the long term success of the company. So, this is the first thing which we can do. We can have a separation. CEO and chairman can be two separate people so that the chairman can keep checking the CEO. Another thing which we can do is have a balanced board of directors with independent non-executive directors. What do we mean by board of directors? Do you know what's the board? What does it do? What do the board of directors do? Who are they? You can say board of directors are basically the people who are responsible for the decision making. So they are a panel of decision makers who take all of the decisions about the company. So, on this board, on this panel, we are saying that you should have a balance. There should be executive directors also. There should be non executive directors also, so that they keep a check on the illegal things, on all the wrong things which the executives can together do to harm the company. So, that is why we keep a balance so that in case anything is going wrong, they can prevent that thing from happening and they can report it to the shareholders also. Another thing which we can do to prevent this problem is have a remuneration committee. Who is a remuneration committee? Are you people aware about the different committees in an organization? Those who are done with double A, they may surely be knowing what are the different committees in the organization. Yes, committees are responsible for taking the decision. So, depending upon what their name is, remuneration committee decides the salaries and the bonuses. Audit committee decides about the audit of the company, right? So, there are multiple. Nomination committee decides who will become the next director in the company. So, different committees are there to take different decisions in the company. So, remuneration committee is that committee, it's that people, set of people who decide how much salary will be given to the directors. So if I tell you that you yourself will set your own salary, will you set a fair amount or will you give yourself a higher salary? Talking about normal, general human nature, we will definitely try to give us our own self a higher salary. So that is why we say that the remuneration committee, where we decide how much salary will be given to the directors, they should not be directly setting their own salary. The independent non-executive directors, the NEDs, should be deciding the salary of the executive directors. They will decide a fair amount which should be paid to the executive directors, because otherwise if they decide their own salary, they will definitely pay themselves a higher salary than they deserve. Another thing which we can do to solve this problem is that no director should be involved in setting the own salary. So if let's suppose we are deciding the salary of Aman should not be there in the committee that decides the salary of Aman. If we are setting the salary of Nidhi should not be there in the committee where we are deciding Nidhi's salary. So this is also one thing with which we can ensure that this problem can be minimized. Another thing is having a robust internal control. Internal control would be one such topic which may have haunted the AA students. Can you people in very easy terms let me know what do you understand with internal control? We do not need to go in as much detail in FM as you need to do in AA paper. Yes, internal control is basically a system that you set up to monitor what is happening in the organization. So if you talk about offices usually have CCTV cameras so that nobody who is not authorized to enter in the office will enter. Usually, when you talk about big corporates, you also have a ID card. The doors will only open if you press the ID card on the gate. So these are a few controls which the companies keep in place to ensure that whatever things should happen, only things are happening that way and not any other way. So the controls in the company should be robust. Robust means they should be strong. We should be having passwords. Only the people who are meant to have the access of things, only they should be having the access. Everyone should not be able to access everything in the company. So this is how, if we have good internal controls, then also we can solve the problem of agency problem. So these are a few principles. If we want to have good corporate governance, these are a few things which we should follow. Just for your knowledge, you people should know that all the governments all around the world, mostly all countries, have their own corporate governance principles. They have the UK corporate governance code. We have one corporate governance code in India also. So different countries come up with the different rules, and depending upon where you're operating, you follow the rules laid down by the government or laid down by the laws. So this is the concept of agency theory as well as corporate governance. This is just how much we need to know for the FM paper. Obviously, for other papers like AA, you have to have a detailed knowledge, but this is the only aspect that we have as part of the syllabus in the FM paper. Any doubts still here, guys? With this, we have also come to an end to chapter number 1. Any doubts? Are you all with me? Any clarity needed? Okay, perfect. So now should we head to the quiz for this chapter? Since you people do not have any queries, I'll take you to the ACCA Study Hub and we will be solving the quiz for this chapter. We have solved chapter number 1. We have discussed chapter number 1. So here is the quiz in front of you. Read through the questions properly and let me know your answers in the chat. Are you all sure? Okay, let's discuss this together. The first question is asking you, which of the following is never consistent with the objective of maximizing the wealth of the shareholders? So three things are consistent. One thing is not consistent. We have to identify which thing is not consistent. So firstly, if I follow corporate social responsibility is I do something good for the people also. Rather than just focusing on making profits, I go for some, tree plantation drives. I go for cleaning of the pollution that I have done. So, do you people think that doing all of these things, they are not going to benefit the company in the long term? If I do good corporate social responsibility, do I not get the benefit of it in the long term? Yes or no? It will benefit. So that means if I get the benefit in the long term, I am maximizing the wealth of the shareholders. That means A cannot be one of our answers. Talk about the statement B. Statement B says I am increasing the levels of my sales. More sales will mean more profits. More profits will mean more wealth for the shareholders. So this is also consistent. That means this cannot be my answer. Then let's go to the last option. It says paying dividends. What are the two ways in which the shareholders make returns from the company? What are the two components of total shareholder return? Capital return as well as dividend. So dividend is also part of what the shareholders get. Now let's go to option C. Option C says satisficing. Doing the bare minimum. Do you think doing the bare minimum is enough to maximize the wealth of the shareholders? No. Doing the bare minimum is not consistent if you want to achieve the wealth of the shareholders. Your answer has to be option C. Is this understood by everyone? No student gave the answer as option C. So I was a little bit surprised. Is it clear now why the answer is option C? Okay. Now let's proceed further. This is the next question in front of you. Which of the following is a sign that the company is failing to maximize shareholder wealth? Again, you people might not be able to answer this at this point in time, but once we cover the entire syllabus, then you will be able to better answer it. But just try and then I will explain it to you. Okay, a lot of you are saying option C. All right. Let's read the options together. We have to select that option, which is a sign that the company is failing to maximize the wealth of the shareholders. First is when the management has challenging performance bonuses. That means they will get the bonus if they do that particular target which they achieve. That target is challenging them. So that is a good thing. They will try to do more efforts. Then the company will be able to earn more profits and they will be able to maximize the shareholder wealth. So A is eliminated. B says investment decisions are evaluated on the basis of their NPV, net present value. So as we will proceed further with the syllabus, you will learn that NPV is one of the best methods to maximize shareholder wealth. So this is also consistent to maximizing, not a part of failing, so can be eliminated. Now you have part C. Part C says the company has not diversified its operations. What do you people understand by diversifying operations? What is the meaning of diversification? Okay, Hitanshu says extending. So that is one of the meaning. Diversification means if right now I am doing manufacturing, then maybe I start providing some service also. Right now, I manufacture t-shirts. I set up a business where I'm providing financial services. Right, Lekna is correct. When you spread into other aspects also. Now, is it necessary that if I'm good at manufacturing of t-shirts, I will also be good at maybe providing a banking services? Is that necessary? No, sometimes I can be good at what I do, but if I try to do something else, I may not be as good. So it is not always mandatory that if I want to maximize the wealth of the shareholders, I have to diversify. Sometimes if I just focus on doing what I do the best, I can give the best returns to the shareholders. So this also can be eliminated. That leaves us with the last option as the answer. Financing of the company is done via equity finance alone. So I told you people, we have been talking about this, that when the company is raising money, there are two options. We can either go with equity or we can go with debt. Now, when we prepare our profit and loss account, what is the sequence in which we do our P&L account? Firstly, we start off with the sales. From the sales, we subtract our variable cost. What do we get after subtracting variable cost from the sales? Sales minus VC is variable costs only. Have you people heard the term contribution? Absolutely correct, Madhumita Levin. Yes. So sales minus variable cost gives me the contribution. Once I subtract the fixed cost from the contribution, then what do I get? What do I get after subtracting the fixed cost also? We get the PBIT, profit before interest and tax. Then we subtract the interest. After subtracting interest from PBIT, I get PBT, profit before tax. Then I subtract the tax, then I'm left with profit after tax. So what is the chronology? I first paid interest, then on the remaining profit, I paid the taxes. So what happens is when you people go and take out a loan from a bank. So whenever you take a loan, what do you have to pay on it for using that money? Interest. Whatever interest that you pay on the loans that you take, that is considered to be an expense for the business. So on the profits, the taxes that you have to pay, those are on the profits. So if the interest is being paid, let's suppose I earned 100 rupees, 20 rupees have gone into interest. Now how much balance will I pay taxes on? 80 rupees of profit. So that means the amount of taxes that I have to pay will also be lesser. Earlier, I would have paid tax on 100 rupees. Now I will pay tax on 80 rupees. So I will save on some tax. So what happens is whenever company go for debt finance, they save some money because of the tax benefit that we get. So if we want to maximize the wealth of the shareholders, it is important that we take the benefit of that tax benefit and we finance the company a little bit with debt also so that the shareholders can get the benefit of the tax saving. So option D is going to be the final answer. If I only finance my company with equity, then I am refusing my shareholders the benefit of cheaper debt, of getting advantages of debt. That is why I am failing to maximize the wealth of the shareholders. Even if it only makes like 50-60% sense to you people at this time, it is totally okay. Once we move to the chapter of debt finance, equity finance, that is when you people will understand it in a much better manner. So here our answer is going to be option D. Are you all with me? Should I proceed ahead? Okay. Third question, which is not going to be an agency cost. Remember, the agency problem was shareholders and directors are different people. The owners and the workers are not the same. So, what would be the costs? Any money that you spend to solve this problem is considered as an agency cost. So, have a look over here. Which one is not an agency cost? That is what you have to choose. Okay, I'm starting to receive answers, waiting for others also. Perfect. You're all giving the correct answer. It is going to be option C. First one is saying cost associated with giving share options to the managers. What are share options? Instead of giving them money right now, I tell them that increase the wealth of the company. When the company does well, the share price will also increase. So I will give you the option to buy the share of the company at a cheaper price. Let's suppose in the market the price is $10. I will give you the option to buy it at $8. So difference of $2, you buy from the company at 8, you go out and sell it in the market for $10. More the price, more will be the profit that you make. So this is something that I am doing so that the directors do not just think of the short term, they think about the long term good of the company. So this is an agency cost. This is something which I only have to do because owner and managers are separate. If they were the same, I will not have to motivate them to think for the long term. If you are the owner, you will automatically think about long-term good of your company. So here, this is an agency cost, hence not our answer. Monitoring the manager, I have to monitor them that they do not cheat from me, they do not steal from me. This is also an agency cost. If you are the owner, you will not have to monitor yourself because nobody will cheat from their own self, right? Then the third one is cost of obtaining a listing on the stock exchange. So whenever there's a company who wants to go on the stock market, who wants now the public to buy and sell their shares, that is when we have to pay the listing fees. So is it any way related to managers and the shareholders being the same people or different people? Any relationship? No, so this is not an agency related cost. That is why this is going to be our answer. Option D also you can see cost of divergent behavior by the manager. Divergent behavior means they are doing something which they should not be doing. So why would somebody do something that they are not supposed to be doing? Because they are not the real owners of the company. They might try to steal from you. So those things which you lose out because the directors are stealing from the company, they are doing bad for the company, that is the cost of divergent behavior. So this is also an agency cost, hence not our answer. So the answer is going to be option C. You're all with me? Should I proceed to the second last question? Okay, perfect. So here is the second last question. Again, this is something that you can solve using elimination technique. Think twice before you give your answers. Okay. All right. Most of you are giving the correct answers. Let's discuss which is going to be least likely to solve the agency problem. So first is if you give your managers profit related rewards. So they will try to increase the profits for the company. So this is going to be a solution. Another thing is you use external auditors to gauge the performance of the company. So what do the shareholders do? They do not trust the managers entirely. So they hire someone called as an auditor who will go to the company. So the shareholders tell them, the auditors, that, hey, listen, these are the people who are running, they are doing the investments for me. So have a look. Are they doing the right thing by me? Are they cheating me? Is anything going wrong in the company? So that is what the external auditors check. And this is also one of the solution for the agency problem. Third statement tells you writing restrictive covenants into loan note contracts. Now, I do not expect you people to know the meaning, but is there anyone who knows the meaning of covenant? What is a covenant? Anyone who happens to know? Commitment, not exactly. You can say covenants are, yes, exactly, Madhumita. It's the terms of loan. You can say it's a restriction, it's a contractual obligation, it's a restriction that you put in the loan. So, what will happen is whenever the company is taking a loan, sometimes the bank will tell you that if you're taking a loan and you're giving a property as a security, that if we do not pay the money back to you, you can sell this property and recover your money. So the bank will put a condition that till the time you do not repay the entire loan, let's suppose the loan is for 3 years. So the bank will tell you, the bank will put a condition, okay, I am taking this property, but the condition is you cannot sell the property before you repay the entire loan amount to me. Because if I sell the property, if let's suppose I do not pay the money to the bank, how will the bank recover the money? So I cannot sell the property till the time I have given it as a collateral to the bank. So this is a covenant. This is a term of the loan. This is a thing which is going to restrict you. So again, there is no relationship. Managers and shareholders are not related to how we do our loan contracts. So this is something which cannot solve the problem. Then if you monitor the actions of the manager, you keep a check on the manager, then you can solve the agency problem. You are worried that they may do the wrong thing. So constantly keep checking them. Are they doing the right thing or not? So option C is going to be our answer. Is everyone with me? Should we head to the last question for the day? Okay. Last question is here in front of you. Give me your answer. Very easy, this one. Read the statements properly. This is a very easy question. Okay, I'm starting to receive answers, and majority of you are saying A, that's correct. Which of the following statements about value for money is correct? So the first statement is economy is minimizing the input cost of the organization. This is the very definition that we have studied for economy. Second statement says efficiency is minimizing the output to input ratio. Is the second statement correct? Or if I change one word, what will it make it correct? Absolutely. Instead of minimizing, it should be maximizing the output to input ratio. Instead of minimizing, it was maximizing, then the statement would have been correct. Third statement is effectiveness is minimizing the cost of meeting the organization's objective. Is it what effectiveness is? No, it is the achievement of the organization's objectives. Enhancements, we have not studied this as one of the three E's, so this cannot be there for the value for money model. So you can simply eliminate the option D. So our answer is going to be option A for this particular question. All good? Any doubts? Okay, perfect. So, with this, we are going to end today's session, and your homework is definitely going to be the OT revision questions, chapter 1. 19 questions are there. And then, if there are any more, yes, we do. OT revision case, chapter 1, 5 questions are there. So, 19 plus 5, 24 questions, small MCQs. So, they are your homework until we meet the next time on Friday, same time, same place. If you have any difficulties, anything that you would like to discuss, you can ask. Otherwise, we are done for today's session. Most welcome. All right, guys. Bye bye. Good night.